Yeah, we are live. So, hey everybody, we're with Dimitri today from Pantheon Insights. So, when you're on that, well, basically Dimitri and I met. We were on a podcast and we were just talking, and I realized he had a very deep knowledge of geopolitics and more. And so we were kind of had more of a conversation. And I was like, wow, we could have a conversation about oil. We have a conversation about anything really. So I think it'd be a great time to just kind of talk about these things, especially with everything that's going on in the world. Dimitri, how are you doing today?
I'm doing great. It's finally beautiful and sunny here in San Francisco, so it's nice to see the weather change. How about you? How's everything where you are?
Oh, you don't even want to know. In Ohio. It changes every day. Actually, this morning we got up and there was a flood, and we had turtles. What we found a snapping turtle. It was the biggest snapping turtle I've ever seen in my life. That was in the
Wow.
road. My girl picked it up, got it out of the road. That's how the day started. Now it's actually sunny and like 70 something degrees. So it's Ohio. Like it'll be snowing probably tonight, and actually the forecast is calling for snow tomorrow. So it's a mess here.
Well, I was about to say, it seems like there's already a connection between the volatility of the weather and the volatility of market prices we're seeing for oil. There seems a lot of
Exactly.
seems to be across dimensions here.
So that's something interesting, something we can kind of go back for. Because, well, one, let's kind of go through your background, because you mentioned to me before that where you worked, you basically had to come up with some other thing that you did as well, and you really studied geopolitics. And so, like, I think that's super interesting, considering that's like what I really love about markets is kind of putting together the geopolitics part of it. Even though I'm mainly a systematic trader, I love history. I love politics. I love everything involved in it. Economics. That was what I was going to say. So let's go through that. How did you get into this route of trading in markets?
No, that's a great question. So after I graduated from university, I got my degrees in political economy. I then started working at Daily FX, which is it was the research arm to IG Group, which is a CFD and a foreign exchange broker. And we obviously, analyzed FX markets, but you also had to look at bond markets. Obviously, you had to look at commodities, especially those that are linked strongly to the currencies, like the Australian dollar, the New Zealand dollar, a lot of EMs, right? And of course, equity indices for broader sentiment. And what happened is that the company, everybody analyzed that, but everybody also had their own subspecialty. And with mine, I thought, well, this is a really interesting time politically. I think markets are going to start being influenced by political forces more. So what happened is I started leaning into that research, and it turned out there was an appetite for it, not because I created some sort of demand, but because it was an underpriced and underutilized, not underutilized, underanalyzed risk that then I started publishing on, and there seemed to have been a positive reception to it. So I started doing that more often. And then that was at Daily FX. Then I did some policy work at the World Economic Forum. And then I founded Pantheon Insights, where I publish a lot of public facing research as well as bespoke client research about the intersection of geopolitics with markets, economies, and technology. Because we're seeing now that in the current geopolitical context, these forces are exhibiting far more pressure on fund managers, portfolios, retail investors, and people are out here saying, why is this happening? What's going on? How do we predict this? How do we analyze it? And that's where you said the history comes in. That's where the history becomes very important. That's where I was looking to actually leverage my degree and say, okay, here's the historical context of the region, right? And that, for instance, helped inform how during COVID-19, when we, which seemed like a lifetime ago now, when the European Union came up with that, I think it was like a 750 billion euro aid package. Everybody thought, okay, great, this is, coming. It's going to be great. It's going to stabilize the economy. I thought, have you not studied European history? They can't agree on anything, or if they do, it's very rare. And especially after the Great Recession, you saw tremendous asymmetry between some of the Mediterranean countries and their northern counterparts. And I said, okay, given that history, given the unique history that's informed everything there, I don't think you're going to find a consensus very quickly. Surely enough, they didn't, and the euro took a couple of hits as a result. So that's an example of not just intellectualizing these things, but actually looking at the history, looking at the data, and making an informed analysis. Not a prophecy, right? Because you can't predict what's going to happen in markets with 100% certainty. Anybody who tells you otherwise is delusional. You can only make really good estimates based on the available data. So that's the kind of method that I started employing, is how do I take geopolitics, not just the history, but the current context, and make it actionable for traders. And that's kind of what I got into.
No, I love that. I think it's incredibly important. One is like, even as a systematic trader, I think, it's important for me to also be able to understand what I'm doing in the market, like what I should be expecting. Should I be expecting major returns? Should I expect that the market's going to be choppy during certain periods of time? What should the political atmosphere bring? Should I be in fear during election seasons? Like, you can literally extrapolate that down over and over again until you get down to the hard facts of how do you put on the trade then, and so I really like that fact. And for me, that's something that I've always kind of gone back to. And one, it's just the most interesting thing in the world is history. The world's a big place. It's kind of the same reason why I got into macro trading, is like, the world's a big place. I love getting up in the morning and trying to figure out what exactly is going on in the world. And that kind of led me to trading futures. So I think this will be a really fun conversation. So let's hop into it. We'll ask the hard question to start things off. Everybody's talking about it right now. What's going on in the Middle East right now? What's going on with Israel? What's going on in the whole world? Because there's a lot of stuff going on, and you'd be the person to ask that question too.
Right. So from a macro level perspective, I think the most consequential side effects of the Israel-Palestine conflict from a market-oriented perspective, right, is what's happening in the Red Sea. We saw a lot of tankers be rerouted, right? I think it's around the Cape of Good Hope, if memory serves. And that has a lot of knock-on effects that people don't seem to realize. And even I was quite surprised at too. So the immediate and obvious one is you saw a geopolitical risk premium put on insurance rates for these tankers, which would make sense. There's a higher risk of something going wrong, so the premiums then rise to reflect that new risk. So you saw that, which obviously then has a cascading inflationary effect, although the premium that you have to pay essentially for these insurers has gone down a little bit. The other aspect of that is that it then requires more fuel to actually take these much longer, albeit safer routes. And then the third one is you are seeing then these delays that result in people either then canceling their orders or the prices are too high. So I think that's one area that I'm watching very closely, precisely because it has so many knock-on effects, not just regionally within the Middle East, but in the US as well as any other countries in our incredibly interconnected world vis-a-vis trade, that has a knock-on effect, right? And especially when it comes to inflation, I think that's very interesting in the context of oil prices. A lot of these tankers now need more fuel in order to make those longer trips. There are those delays to account for. So I think as we continue to see that situation develop, what I'm curious about in the context of Fed policy is how much is it going to contribute to inflation? Certainly we're seeing crude oil prices rise a lot more. I think it's now pushing $85, $87 a barrel. Although for that, there's like three big geopolitical forces it seems pushing oil prices higher in the near term. The first one, as I mentioned earlier, are the Houthi rebels, or the Houthi strikes against tankers. Not just American, we actually saw a Chinese one get hit recently, which was quite surprising considering Iran and China have precariously good relations. They have their own trade deals that they're making, including a $400 billion investment over the course of several decades in exchange for cheap oil prices. The second geopolitical risk we're seeing that's pushing oil prices higher in the near term are the recent drone strikes, specifically Ukrainian drone strikes against Russian oil producing facilities that have knocked out some of these, that reduced their capacity to only operating at 70% of output. So it was reducing a couple of 100,000 barrels of oil a day. And that's not just one, it's multiple. And the third one most recently that pushed oil prices higher was an Israeli missile strike against an Iranian consulate, I believe in Syria, specifically Damascus, that killed an IRGC, Iranian Revolutionary Guard, a senior commander. All those three risks are pushing oil prices higher in the near term. In my view, though, and we saw this in 2018, 2019, a bit of 2020, where we saw attacks in the Suez Canal against tankers. We saw the Saudi Aramco strike by Iran. I think it was also the Houthi rebels that are backed by Iran. And what's interesting is that, yes, that did elevate oil prices, and you could overlay the headlines of when those risks were made public with oil prices to see a direct, relationship. The problem, though, is that oil fundamentally was following a different trend, meaning it was following wherever the demand was. And the demand at that time was waning in part due to the trade wars. And that was coming despite the the production cuts that we were getting from OPEC. With here, we're also seeing cuts from OPEC. I think they're taking off like 2.2 million barrels of oil. Saudi and Russia are leading the charge in that, and they're extending their cuts throughout Q2. And you'd think, well, why would they be cutting production unless they think growth and demand is somehow going to be weaker in the future? So that's something to consider as well. Oil prices seem to be trending higher now after falling for a couple of months, or I'd say a couple of months, precisely because these near-term political risks are kicking in. We are seeing slightly better growth out of China, which is a big driver and consumer of oil. So I think these are like all the big geopolitical factors looking into oil. As for a trading angle, obviously I'm not giving official trading advice, but I think you can trade the volatility of near-term geopolitical risks. And I think in the current environment, it's conducive to disruption and friction, which is a tailwind for oil prices. As for the growth outlook and how that fits into there, and that's something we can talk about more in just a sec, I think the US is going to play a really big factor. Europe's growth rate is going to be anemic. I think it's going to be 0.8% for 2024, while the US is going to be, I think, 3.4. China is having a lot of domestic problems as well as foreign external pressures that are potentially going to undermine demand and hurt crude oil. That's kind of the big outlook. But yeah, I'd love to get your thoughts or answer any questions. I know I touched on a lot of topics there.
No, that's great. We just have so much going on right now. I think it's incredibly important to kind of have someone on like you, because people always have these questions, especially when you're in the macro space. Like, I'm a macro trader. We trade everything, and especially clients, they want to know what's going on in the world. What is going on, what is affecting my portfolio. And once again, I'm a price action person. So, when you're seeing something move, you're seeing something trend, I'm going to go that direction, probably no matter what. Like, anybody could say something to me that's different from that and say that, hey, there's this political risk here, and that's not going to change my decisions. However, at the same time, it's incredibly important to have these conversations and understanding what's going on in the world, what can affect your portfolio. Not to mention, there's a lot of people who watch this who want to know. It's not exactly my expertise, but I absolutely love, talking about it and hearing it. For me, there's just so many factors right now that are going, especially into like we're talking about in the oil prices. We have an uptrend. For me, that's where everything started. It's moved into an uptrend. It's making new highs, but this is going to put a lot of pressure on the world. If oil gets back up to $100 with all the inflationary pressures that are already out there, not to mention looking at the Fed, and that's something we could talk about next. What's the Fed going to do? Is the Fed going to sit there and just continue to say we're going to cut soon in the face of rising inflation? I kind of see that as a major headwind for the Fed, and I really doubt that they're going to do that. That doesn't make any sense for me. I know some people are talking about it, but I guess I've seen these cycles many times, and after seeing these cycles so many times, I know they're very slow to cut rates. They're very slow to cut rates. Now they're at a pause. Something could happen, something significant. It either has to be economically, market-based, and if one of those two things happen, or a black swan of some form, I think we could absolutely see something like that. But for now, it's like, why would they cut rates? It doesn't make sense to me just yet. Maybe you have a different opinion on that. I'd love to hear it.
Yeah, so you touched on a lot of good points there. You talked about the idea of there being a black swan event that could potentially derail all of this. And I think the idea of a black swan event, obviously, in terms of probabilities, it's a tail risk, right? It's it's on the margins, but it could potentially uproot everything. So taken under that light, I think if you look at the current geopolitical context, which is that we're living in a multipolar world, even though the US is still the world's hegemon, right? Biggest military, reserve currency, which offers tremendous geosecurity and geofinancial leverage, there are still competing players that do wield some significant leverage, like in the commodity sphere, whether it be Russia, or in the supply chain sphere, whether it be China, or emerging powers like India that are actually set to eclipse the US in GDP by 2075, at least according to Goldman Sachs. Under this environment, where you don't have one rule set or setting standards for everybody as much and enforcing it. You are seeing competing rivalries and nation-based priorities take precedence over adhering to multilateral institutions. In short, nations are now going, I'm going to do what's best for me, regardless of the global context. I'm not saying they're completely disregarding rules, but we are seeing that happen much more often. The invasion of Ukraine by Russia is just one very stark example of that. So in terms of like Fed policy, bringing it back to there, I think what will be interesting is that if we do see the Fed cut rates, one, I think it'll be gradual. I don't think it'll be a 50 BPS cut at once. I was talking to Kevin Green about this yesterday, really great analyst and great guy. And what he was saying, and what we both agreed on, is a 50 BPS cut may actually produce more market turmoil with downside volatility than upside, because then people would think, what could possibly be so wrong that the Fed knows that we don't, that they think it would necessitate, after months of caution and waiting and hiking even before then, to suddenly slash rates at this level? There would also then be the concern of, okay, well, what are the inflationary effects, which is something you alluded to. I think with a weaker dollar, because Brent and WTI is priced in it, by definition, a weaker dollar would lead to higher oil prices, because you would need more dollars to purchase a certain, 1 barrel of oil. That could also have an inflationary effect. I think something else to consider, though, in that context is that as oil prices rise, I do think one counterpoint to that is that with the price per barrel reaching a certain level, let's say it's 100, smaller operators who have much higher break-even price rates than, let's say, a Chevron or, a Saudi Aramco, they'll start entering the market. Now, granted, it won't be immediate, it'll be gradual, but that could lead to a stabilization eventually. That is, of course, predicated on the assumption that demand in the US continues to remain strong. There are several factors that indicate that, not factors, data points that indicate that there is actually more weakness in the US economy than people think. That's not to say that markets can't keep trending higher, right? Because you don't want to fall into the trap of Robert Kiyosaki, who says, the world's going to end, gold is going to, surge, the dollar is going to go to waste. I don't mean to sound unprofessional, but he's an idiot, right? Yeah. And, and he's one of those macro doomers, where he says, if you took his advice and you didn't invest in, let's just even say, a boring equity ETF, you would have lost out on so many gains, particularly in 2020, 2021, where you saw just markets surge, and even last year. So I don't want to fall into that camp, and I want to draw a distinction between analyzing what the macroeconomic data indicates and what markets are doing, right? Markets can keep trending higher because they're trading on a story. There's a great book, Narrative Economics, by Robert Shiller, a famous creator of the Case-Shiller Index. And in it, he talks about the virality of stories and compares it to how viruses spread. In my view, markets are operating on a story with a couple of premises. The first, we're getting rate cuts. The second, the US economy is stronger than expected. 3, we are not going to get we're either going to get a soft landing or even no landing at all, meaning no recession. That's a lot of ifs. That's a lot of things that need to go right, which means that if your base threshold of expectations are that high, like in life, as in markets, there is way more room for disappointment. So I think that's where a black swan event could catalyze a lot of downside volatility. Having said that, that doesn't mean people should exit the markets, but it's like, okay, yes, if you'd like, if the music's playing, keep dancing, as they say, but just, keep an eye out on that data. So when you see the data start to crack and you see markets pick up on that, you can position yourself accordingly.
It's a lot to unpack there. That's good, man. I really enjoy that. Especially the part about, thinking so much of downside, like that's the other thing, is like, you have to think of it two different ways, exactly how you said it. You have some people out there that are always saying the market's going to crash. It's all possible, right? The market could crash at some point. However, like, you'll never make any money if you continually just stay out of the market thinking it will crash all the time. You also lose a lot more money trying to short the market in an uptrend. Like that's going to cost you a lot of money, but these people talk about it all the time, and put all your money in gold and you can do this. And really there's just a bunch of simple ways to look at it. One simple way, just as you said, The markets are, very complex. I can't tell you the future. I can just come out with the most probabilistic outcome. Any good trader, whether they're fundamental based, technical based, that I've met that's made money over the years, that's all they try to do. Put the probabilities on our side. And then also, I think it's also good we're talking about risk, because it's something that comes up a lot on spaces when we talk, which is people having the conversation, hey, there's risk out there. And people like, you guys are being doomers talking about risk. And it's like, no, that's the whole game. Like, the whole game is understanding, like, what do I risk? How much do I risk? Am I willing to risk? Like, when it's fundamental, you have to figure out the most probabilistic outcome. Then what's your risk to the downside? What could hit you out of nowhere? If you're a technical trader, you can put in a stop loss, understand technical levels and so on. If you're even an algorithmic systematic trader, you do that systematically. Like, it's constant. Risk is everything. So risk to reward is exactly what we do here. So I'm glad you brought that up. But looking at the Fed, like you said, there's a way of looking at it and just kind of going, okay, well, what does the Fed see out there that they would possibly bring up the fact that we could see rate cuts this year? No. Especially if you set an environment that was out there and you were like, okay, what is the environment out there where people would cut rates? And you said, okay, well, the market would be melting up. Commodities would start to move higher. Very risky assets would start to move. You could really say we're kind of in that environment. But at the same time, it's the Fed, think back to August 2019 is a good example. The Fed saw something in the repo market at that time. They cut, I think it was like 25 basis points or something at the time, but something very small. Once again, like, they're able to see certain things and know about certain things that we're not. And also the market is very disconnected from reality. It's the reason why a lot of trend following traders can make money. It's not that they're right all the time on the world. Think of 2023. The NASDAQ continues to melt up as basically the world, and fundamentally it makes no sense to do so. Put all of that together and you have this strategy kind of to outperform while everything might not look good fundamentally. And so if you look at the world, you could see why there'd be many reasons to cut rates right now. If you look at the world, if you look at the markets, are very different things. So I really like the way you put that. I guess, getting into it, I guess I don't really, the biggest thing that I always know is that I don't know. I don't know exactly what the Fed will do, but I would be very surprised by a rate cut here. But once again, I just think we need a catalyst. And I think there's a lot of things under the surface for a catalyst. So, pass that to you. What do you think about that? Catalyst wise, what could people be looking out there for, in the political spectrum or economically? Like, what would be a black swan event that you would be looking for, or something that could kind of tip you off that things could get worse, or that the Fed would just cut rates right into it?
No, that's a really great question. And that's, I think, fundamentally the multi-trillion-dollar question.
You're the guy to ask.
So in terms of events, okay, so let's look at it from a couple of angles. Let's look at the geopolitical angle first. What are some geopolitical black swans that could potentially be so severe and wide-ranging that they could alter Fed policy? In my view, you would need something that's not a temporary blip. For instance, the Red Sea attacks, or the three geopolitical forces I mentioned earlier, like the drone strikes on Russian oil facilities, or Israel targeting a IRGC official. Those are all blips. Like, they're consistent, but if you want to bring a stove metaphor, they're simmering, right? They're simmering risks that are in the background that pop up every now and then. You see a little bit of a boil. Though, in order to get something, I think, like a big black swan event that would shift the entire set of expectations for Fed policy, you would need something really, really big. Okay, what was it that that tanker that clogged that one trading route in, what was it, 2021, 2020? I think it was in Iran. It was in the Suez Canal, wasn't it?
Yeah, the Suez Canal, yeah.
Suez Canal, yeah. So, I mean, that we saw, in addition to the memes, which were just phenomenal, you did see a lot of inflationary byproducts from that emerge. Now, how much force they exerted on Fed policy is difficult to quantify, but I don't think it'll be one thing. I think, and I'm sort of thinking out loud here, I think part of it will be how many tiny little things will add up to where it'll derail Fed policy. And so instead of death by a club, it's death by 1,000 cuts. Maybe it's the aggregate accumulated geopolitical risks that provide upward forces to inflation that across regions, right? We saw it in Eastern Europe, we saw it in the Middle East, that could potentially derail the Fed's outlook. In terms of a macroeconomic perspective or like financially, you talked about catalysts. I'm glad you brought that up because markets are forward looking. They think, okay, why should we invest in this unless there is some reason that we believe that it warrants our capital. So when it comes to catalysts, I think in terms of upward ones, Fed rate hikes are already priced in. So that catalyst is done. Now it's just a matter of when, according to them, according to, let's say if you look at futures markets for Fed rate expectations. Gosh, I lost my train of thought for a second. Sorry. Yeah, catalysts. Earnings, I guess. I have a rule. I don't trade into earnings. It's too volatile. I like to distinguish myself as a long-term investor, not a retail trader. I don't have the stomach for it. I do sort of long-term thematic investing and, obviously invest in some, boring equity indices just to have it grow in the background. But I think in terms of catalysts, it's unclear what markets have to continue looking forward to. The AI boom in NVIDIA, we saw how a couple of weeks ago with the NVIDIA earnings call, everyone's saying if NVIDIA doesn't beat expectations, then it's going to be the end of civilization, by which they just meant there was going to be a market collapse. Obviously, it was a joke, but there was some truth in that joke, which is why there was so much market angst. And the way I thought that it was true is because if it was all a joke, markets wouldn't really react that positively after, let's say, they beat earnings. But they did. They exhibited, I wouldn't call it irrational exuberance, but they were certainly very happy about it, which reflects that there was an underlying concern that things wouldn't go right. So in terms of catalysts for upward forces for, let's say, to keep markets rising higher, to keep markets trending higher, I would say stellar earnings, breakthroughs in technologies, whether it's AI or quantum computing. We can talk a little bit about that later. And I guess the Fed being more dovish than expected, but I guess even then they've made it very clear repeatedly, higher for longer, and we're going to continue assessing the data. So I don't know. It's kind of unclear. It seems to me that markets are trading almost like as a herd, like a momentum trade. So, I don't know. I realize that may not answer your question, but I'm still trying to figure it out myself.
No, that's perfect. I mean, so what I do, I have two different portfolios. One portfolio is completely systematic futures. The other portfolio, the ETF portfolio, there's a little bit of discretionary trading in there. And what I do is very similar to that. Is like, what exactly is the catalyst? Like, you can't. Number one, we can't exactly know, right? You can't. I will never go, hey, I have long position in this. All the signals are saying to be up. And I also believe, like, when you put on a trade, and this is something that's been told to me as long as I've been trading. When you put on a trade, you do not then decide when I'm going to get out in the middle of it. You put it on beforehand. You know exactly where you're going to get out before you even hit the buy button. So whether it's a trailing stop, whether it's an exit signal, whether it's a fundamental catalyst, whatever it is. So, for me, it's the same thing of like, hey, let's just kind of put together what these scenarios could be. And I believe, like, very much like you, like, there's a lot of them out there. I can't tell you exactly what it is. Would it make me sell any of my positions right now? No, absolutely not. But I would like to, talk about it, figure it out, wonder exactly what's going on. I like the way the market's kind of heading right now. We kind of have a widening of breadth. Any good bull market rotates, like that's what we'll see. So now we're kind of seeing the energy sector kind of catch up. And the catalyst that me and you, when we first talked, started to catch up as well. So, when we have all of those things kind of coming into play, now we kind of have a very good recipe for an uptrend in the energy markets and the commodities markets. Now, really also then what's the headwind for energy? You know, is there a chance that you think that energy could be a bad trade here, or oil could be a bad trade here going alongside? It's taken out some levels, it continues to move up, it's in an uptrend. But I'm curious, you know, what do you think about the energy trade right here? When do you think it could stop? You mentioned the dollar. I'd love to hear a bit more about that as well.
Yeah, so right now, I mean, I see a pretty compelling case for higher oil prices in terms of what I mentioned before, like the geopolitical risk premium in the near term, combined with OPEC cutting production. I think that's very two bullish forces. And the third one is if we continue to have strong economic growth, particularly out of the US, and let's say better than expected growth out of China, that's also a demand tailwind, right? So there's all those upward forces. I think those are all reasonable. The potential crack I may see there is if we realize the US economy is not as strong as we suspect it is. To give you an example, I read these strange headlines where, on the one hand, I see record breaking job growth, stronger than expected GDP, all good. And on the other, I see credit card delinquencies rising, people pulling from their 401k. They talk, and you see, you know, student debt payments coming in, although that actually isn't contributing that much to reducing consumption. My concern there is how can these two headlines exist at the same time unless the US economy, as far as the consumer goes, is running at this point on fumes? There's a really interesting study done by the SF Fed that found that, or yeah, going back to the job creation before I get to that, there's this one tweet that was put out. I can't remember the account, but I think I retweeted it, and it was just showing job growth for January. It said, "Congratulations, we added, you know, tens of thousands of jobs here." Yes, but those were part-time. Full-time jobs, we actually lost 96,000. So I think that's a distinction that people aren't picking up on as much. And chances are, if you're working a part-time or two part-time jobs, you're probably in a lower income bracket, which means you spend a larger portion of your income on discretionary spending than someone who makes more. How that relates to the Fed, specifically the research study they published, is a lot of the consumption now, funnily enough, it seems, according to their study, is being driven by very high net worth individuals. And part of that cash fund that they have is being spent on so-called revenge spending, which is, I didn't get to do this during the pandemic, so I want to do it now. You also can't underestimate the irrational consumer, right? If there's anything we've learned in economic theory, is that the consumer is not rational, meaning they may make irrational purchases for things that they can't afford at that time, but want to, you know, for whatever reason, right? So I think the tailwind that we could see, the headwind we could see for oil prices, is if the US consumer stops consuming. And I think that's when everything can not grind to a halt, because that's a hyperbole, but that's where you could see a serious slowdown and markets going, uh-oh. And that's, I think, where you could see a little bit of a tailwind, headwind for oil. But again, I think you have to contextualize it, right? So in other words, here's a good example. NVIDIA, right? NVIDIA, stock of the year, stock of the decade, you know, it's been surging. We do see how some of its processors, specifically some of, I think it's A100s and other AI interfacing chips, were targeted by the Biden administration. I said that this was a risk. However, I said, while keeping in mind that this is a risk that could drag down share prices, which it did, the domestic demand and current dynamics vis-a-vis the AI industry is so high and so strong that it will override the downside effects of these geopolitical factors. Same thing kind of here with oil. That same principle. I think there are numerous tailwinds that are supporting it that are currently overriding the headwinds that may be coming down the line.
No,
I'd be curious to get your take on it. Where do you think oil prices are going? Do you see any headwinds yourself?
So what you said is very interesting. That's what kind of I was thinking, because I was like, what exactly do I say to that? Because that really is it's eye-opening. It's why I like to have these conversations, because especially somebody who has a very different background from me. Some people, you know, I've seen it lately in the comments a lot. People like really enjoy that we bring on so many different people. And because it's always helping, it's always helpful when somebody's an expert in something different from you to open your eyes in a different way. And, thinking about it like, when the US consumer stops spending, it's like, yeah, exactly. That's something that we do have to watch out for. And that is the ultimate thing. Because really, it's like, how much debt can you put on yourself? How much burden can you put on yourself? And it's something I talk about a lot, which is, people want, when they talk about the idea of trading for themselves, people, once again, it's really hard to do. I'm not suggesting anybody do that. I always try to talk people into the opposite, but trading for yourself is incredibly hard to do. But people are not attracted to it just because of the trading. They're attracted because of the freedom. And it's like, freedom isn't just having the Lambo and making all the money in the world. Like, that's what the media tries to sell you. Really, it's the opposite of like having money to where you can do whatever you want, where you're never in pain, your family's never struggling. Like, those are the things you have to really care about. And once again, it's like when you look at the world and you're like, but nobody, what I just said is very few people think like that. And so you watch people in the United States. I mean, what happened with the stimulus checks? People got stimulus checks. What did they do with it? Well, they didn't just put it in their savings and they didn't buy Nvidia or any of those things. Like, yes, there's a couple of those stories, but for the most part, those stories are not around. They're very rare. People just bought crazy stuff with them. They bought TVs, they bought, car prices went up like crazy right then,
Yep.
they just went and bought a bunch of stuff, even though, the world was kind of in a big, terrible economic state and a lot of turmoil at that time. So it's really, when you look at it, it's like, okay, well, when do they stop spending? And it's, I don't know, I can't ever put a time frame on that or how much debt somebody can take on. I've seen people, we all have friends right now who are making something like, 100K a year, let's say they make 100K a year, and they're just lumping debt onto themselves like crazy. I have friends that are more successful than that who are still in major trouble. And the reason isn't because they're not making enough. It's because they're spending so much. We all outspend here in the United States. We don't save any money. Nobody has any savings here. So you're right. Like, what exactly would happen if, like, let's say credit cards, they said, hey, you can't take any more money out. Hey, everything's maxed out. You're done. That would be a detrimental situation. But once again, it's the other part of it that's important to say is, how much money does the average citizen really put into the market? It's not much. But these big banks and so on. So it would have to be a trickle up effect, to say a very terrible phrase. But because basically, you're talking about from the bottom, everybody would be hurting, and then that would also hurt the banks and so on. So it's a very interesting way of putting that, where it's like, yeah, at what point does the US consumer stop consuming?
Right. And this is where, I think teasing out the difference between a long-term risk and how you trade it are two important distinctions. And that's something I mentioned earlier, which is obviously watch market price action and trade according to whatever your risk appetite threshold is. But at the same time, keep these macroeconomic risks in the background. So when you start to see the effects bleed into markets, you can say, aha, this is what they're picking up on. If they are just beginning to realize how bad this could potentially be, maybe this is a prudent point for me to liquidate some of my positions. So it has an actionable approach to it. And something you mentioned earlier, I wanted to touch on again. You mentioned catalysts. So a lot of what I do is thematic investing, specifically my three big thematic investment vehicles: defense, AI and quantum computing, and energy, vis-a-vis the energy transition. I'll just talk about defense for now because I think that one's really interesting. Like you talked about, what are some catalysts that could potentially trend higher, right? And with this specific defense industry, right, the National Defense Authorization Act, which essentially Congress, Congress signs it essentially to allow the allocation of funds towards various defense-related initiatives, like the Pacific Deterrence Initiative, which got a record $9.1 billion, which says everything you need to know about where military priorities are. That has been passed for 63 consecutive years. And we've seen how Congress has become a lot more polarized since then. And yet on this one area, they agree. And this isn't like a moral statement that I'm making in either direction, supporting or against. It's rather saying, look at what the data shows. They agree on defense. So if they agree on defense here, and we are seeing increased geopolitical tension, then the result might be, well, okay, the US is the global hegemon. Their biggest asset besides the dollar is the security architecture they developed for the world. You are going to need a lot of security, essentially, not just globally, but now particularly in China or around China in the Indo-Pacific. So there's a lot of catalysts pushing military stocks higher, because you're also seeing that play out in this multipolar world, whether it's the conflict between Israel and Hamas, whether it's Russia and Ukraine. In fact, in a rather morbidly prescient way, the weekend of October 7, obviously without knowing what was going to happen, I published an article titled, "Will Geopolitical Risks Push Defense Stocks Higher?" Monday open, Lockheed Martin, Northrop Grumman, Raytheon, all shot higher. And you saw that there, during the heightened period of the conflict between Israel and Hamas, you saw military stocks, I'll use Lockheed Martin as an example because it's the world's largest defense contractor, trend consistently higher, even though it was on a downtrend. It was on a downtrend. October 7, popped higher, was trading at 11% premium for several weeks. You can literally quantify how geopolitics were affecting that industry, right? And if you want to learn more about that, to you or anybody else who's interested in reading this, on my website, Pantheon Insights, you can get to it through my Twitter bio, my Twitter link right here.
I'll put it in the chat.
Yeah. I wrote several thematic investment pieces. One of them is on defense, where it has a much more detailed breakdown. And with thematic defense, it's looking at what are the catalysts driving this particular industry or sector. I seldom mention individual stocks. I mentioned Lockheed Martin because, again, it's such a quintessential example. But generally, that's what I mean by when I look for catalysts. They say, okay, what forces that are secular, meaning they don't just oscillate, that are going to push a particular industry and shares in that industry higher? So I'm glad you mentioned catalysts for that reason, because it is, I think, something that is not frequently talked about in the context of looking forward with markets. Like, okay, what is the thing that's going to keep pushing it higher? What's the story that's compelling these investors to keep piling in?
No, I love that. And we got people kind of picked up on the consumerism angle of what we're talking about. And one, Crypto Nick also wrote, you're on a roll, and quantifying geopolitical circumstances. And I think that's incredibly important, because I think when we talk about, I talk about a lot of systematic and quantitative trading on here, and people don't understand that that's actually a real thing in fundamentals as well. Like, God, I'm going to forget the name for some reason. It was in Hedge Fund Market Wizards. It's one of the most famous systematic fundamental traders ever, but he's a systematic fundamental guy. There's been lots of systematic fundamental people, and you can quantify all of these things. So it's not something that, we're just talking about like, hey, you got to be systematic and trade this specific way. Like, you can do it fundamentally too. And kind of getting back into that angle, I got a couple comments that I wanted to bring up here to chat on. Most people are consumers, and it's an insatiable habit. I really love these comments because, one, I like that Crypto Nick also said consumerism is deep in our DNA these days. Happiness is spending money in the mall. I love that people are picking up on this, and especially like for me, and I'm going to sound like an old person for saying this. I'm not that old to even say this, but I feel like the younger generation is finally getting it. Like, you don't have to have like the craziest stuff to look, to make other people happy, to keep up with the Joneses, like things like that. It's ridiculous. Like, some of the richest people I've ever met, they drive the richest guy I actually do know drives around a Honda Civic. It's a 2001. It's white. Yes, it's a very nice Honda Civic. It's kept up really well, but once again, it's a 2001 Honda Civic. Not saying you got to go to that degree, but I'm just saying it's like one thing rich people usually know, people who are actually wealthy, they know that buying a car is a depreciating asset. Why would I buy a brand new car all the time? I had a great uncle, and he would go out and buy like a barely used Buick. You know, he had lots of money. He was very, very wealthy. He could have bought any car on the lot, brand new, 7 days a week, and probably not even noticed it. However, he ended up buying a Buick, barely used all the time, to save a little bit of money, understanding driving it off the lot, it's going to lose this much anyways. Why would I do that? You know, and you kind of see that over and over again. So I'm kind of just excited that the comments are coming in. You know, people are kind of saying stuff like that. It's exciting for me because I know that, you know, as a younger person, it feels bad when you're like, you see your friends or somebody you're working with and you're like, man, they just drove in this really nice car and they did this really, you know, they have this really great house and they have all these amazing things. It's like, you have no idea. Be in the fund world for a second. And I'll just end on this quick story.
Yeah.
We've had people come up to us and be like, hey, I want to invest with you. To get into a futures fund, it's a little bit of money. So we would sit down and we would ask them about their finances a little bit. And basically, like, the people who would show up in the nicest vehicles, they would have so much debt, like, that they would have to pay for monthly, that we would be like, hey, you're going to end up needing this money back very soon. And they would get very offended, you know, and like, I wouldn't mean to offend them, but it's like, that's how it happens a lot. So I know that a lot of the people who look the richest, they might not be. And that doesn't mean that, you know, there are plenty of people who have really nice cars who also have money. I'm not saying that, but I'm saying a lot of people try really hard to look the part. I mean, how many friends, you know, we're both in finance. I'm sure you get this. How many friends have we had over the years who have like the nicest car in the world, but they're sleeping in the car every night, you know, or they're sleeping at your house on your couch or something, you know, like that happens too. So I'm just very
fortunately that hasn't happened. Fortunately, that hasn't happened to me yet. But you know, you never know. 2024 is an exciting year with all these layoffs in tech and finance. You know, you never know.
You know, it's happened to me. I have definitely had a friend in that scenario. You know, I mean, it's happened to my fiance as well. Has a story about that. You know, like it does happen, and it's not that not making fun of these people, right? I'm kind of just saying, like, I hope that everybody's kind of understanding and gets it. Like, you know, there's nothing wrong with saving your money and if you're continue to just put your money into the market and compound all those years instead of putting the money out of, you know, basically into your car all these years that's depreciating every day, you'll have a lot of money by the time you retire, or you'll have nothing, you know, very quickly. All that has to go wrong in like a very nice car is you just got to fix it sometimes.
Well, I think there was a quote that I read that said, what is it? I think it's like a wealthy man is not a wealthy man is not one who has many things but few wants. And I think that's a really good way of putting it. But also, you know, to tag on to that, I know we have to end our session here, but people say, oh, well, you know, it's just a couple of $100 a month. Like, what does that matter? It's like, okay, yes, but we're talking months. You're not taking into account the aggregate effect of that. And you're not taking into account how much money that money in the aggregate could make. In other words, compound interest. So I think that's something that people seldom, you know, sometimes look at. Not all people, I don't want to generalize. Those people who look at a car, like with me, two of the cars I've had in my life, they've both been used. I didn't want to buy a new car because I know as soon as I get in there, I'm losing I would theoretically lose thousands of dollars just driving it off the parking lot, or driving it off, off the dealership. So no, I think it has to do with like what habits you form early on.
No, I agree. And I think, you know, it's I was fortunate to grow up in the family that I did, you know, like I got to see, like, we weren't wealthy by any means, we were the opposite, but my great uncle was wealthy, and I got to see how he handled things, and that kind of taught me how to, you know, like I always buy used. I never buy a new car. Even the businesses I've run, they've all been used vehicles. You know, there's no reason to really, for the most part, there isn't much of a reason. You could buy something with 5,000 miles on it, 10,000 miles on it. It's much cheaper than buying something with 0. And then also you're not losing that amount of value driving it off the lot. Like you said, it's thousands. And not to mention, as traders, you know, as investors, like it might just be my brain, but it's mainly, I always am like, oh, what I could have done with this amount of money, you know, like I could have put this into this, or I could have done that, you know, like my brain like gets angry about it. And so I really try my best not to. So I'm hoping that, you know, people listening kind of get some ideas how to handle things. I saw there was another comment like find a place to live first, a BMW second. I'm not making fun of people who do that. I'm saying like the world is a tough place and living in the United States is tough. And people have very high expectations of things around them. If you hear somebody's in finance, for example, you expect for them to show up in a Lamborghini and like all these crazy things, but really that's all perception. If you actually do meet these people, it's much different than you'd think. So now, Dimitri, if you have anything else you want to end on, because I do have a little bit of time. I'm not worried about going over a bit. If you're not, I don't know if you have another space today.
So the last thing that I'll say is that's the economist in you speaking, looking at opportunity costs.
Yes,
I would say.
Yes.
Looking, it's like, why didn't I invest in this? Why did I spend it on this? I could have done this. So no, I totally understand. And again, I think it's a matter of forming that habit early on. It takes tremendous discipline. I think particularly in metropolitan areas like SF, New York, Hong Kong, London, keep naming it, where even though, let's say globally, you may be in the top 0.1% out of 7 billion people, 8 billion people, locally, you feel relatively poor. And I think that can then drive a lot of this, FOMO spending, like people secretly going into debt in order to go on vacations with their friends to not be socially ostracized. That's unfortunately very, very prevalent. Fortunately with my friends, that's never been an issue. We never try to impress each other. We just, try to hang out and have a good time. But that does drive a lot of behavior. And I think, and maybe this is something we could talk about on another show, another time, but I do think social media plays a really big role in fueling that sense of FOMO, which does have a tangible impact on bringing it full circle on consumption, on debt levels, and what that could mean for future growth. One person, that means nothing. Iterate that across hundreds of millions of peoples and hundreds of millions of dollars, or probably billions, actually. That effect compounds.
I completely agree. I mean, that the social media part of it is probably the most important part of this, and I think it affects traders in the worst way. They get online, especially like you start trading, and I'll meet many people who they start trading. They want to be intraday traders. They want to be day traders. They want to make money quick. And so you think like, hey, I could make $10 every 5 minutes if I did this over and over again. But once again, it's much harder than that. If that was possible, everybody would do it. But they watch somebody on social media and somebody says, hey, I remember I was on a space earlier this year, and at the beginning of this year, everything went against us in our portfolio for a couple of days. And I mentioned I was down in the portfolio, and people were like, oh my God. Like it was like I said something terrible. And I was like, well, that's normal trading. Like it goes both ways. Like you don't have it's like looking at the S&P and not understanding why I'd be down in a day. Like everything's going to go through cycles. It's going to go up and down. But being the real one on that channel, and like all my stuff is public, and saying it publicly, like people don't get that much on social media. So because you don't get that much on social media, then you think trading is this easy thing, and you think everybody on here is making money and every trade they're doing is right. I had a guy, and I'll pass this one to you too. You'll laugh at this. I had a guy who was talking to me, and he was like, yeah, so where exactly does natural gas stop, like when it's going down? And I was like, I have no idea. And he was like, wait a minute. Like, you're a professional trader and you don't know where natural gas is going to stop. I said, I have no idea where it's going to stop. I said, right now the trend is down. I don't know. It could end up at, it could go all the way down to zero. I really doubt it hits zero, but I said it could go anywhere from 0 to 1,000. I have no idea. And he was like, man, that makes no sense. I thought people like you know exactly where things go. It's like, no, there's no possible way to know exactly where things go. There's no way to make money every day. We put the probabilities on our side. We, these people who are saying they're making money every day in the markets, they're lying. These people who say that they got 90% win rate systems, they're most likely lying. So take those little things and add it to your own trading, and then you can figure out how to make money and do this successfully. But if you're thinking and your expectations are to make money every single day, take money out of the market like it's a job every week, like that's going to really hurt your trading. And it's going to keep you trying to keep up with the Joneses, trying to make yourself look better than you really are. So, I really love this conversation. But
Well, that's why I enjoy, content like yours and a couple of other accounts on FinTwit out there, like Liquidity, or a couple of other ones where they find these, people on TikTok or Instagram saying, "Here's how I made $10,000 in one day with this secret
Yeah.
strategy," right?
Yeah.
And like, it's nice to see people come out and troll them essentially and say you're completely lying. Like you're so full of it. So it's nice to see people with actual trading experience and a level head come out and say, well, actually, no, if they're saying this, they're most likely lying. Because if you had any idea of how complex the market was, how many variables, because essentially someone says, I know where the stock is going. What they're saying is, I know exactly what hundreds of millions of people want to do and what
Yeah.
decisions they're going to make
Yes.
with all the different circumstances in their life or different strategies. That is
Mhm.
such an absurd statement to
Yes.
make, and it's so arrogant, and it requires just surface level analysis to completely deconstruct that ridiculous kind of claim. But yeah, that's my that's my parting note: is don't listen to those charlatans. Bringing back an old word. If I want
Yes,
to, if I
exactly.
want to carbon date myself, yeah.
No, that's a good point, man. And really, like, it's the truth, because I don't think you really get good at trading until, and investing, however you do it, because everybody's going to be different. Until you understand that everybody's different, until you understand that all we're doing is trying to put the probabilities on our side. We don't know exactly where things go. I take buy signals. I go, okay, the probabilities are on my side. The risk reward is set up correctly. I buy it. That's the end of it. And it's profitable that way. I've put up good returns year after year. However, it's not without getting things wrong. That's just the way it goes. You're going to get things wrong. So how do you not get things wrong from time to time? And that's doing things like you do, putting the probabilities on your side, looking at the risk, looking at the reward. And that's what we do here. So love this conversation, Dimitri. Let's try to do it again soon.
We definitely
More than
will.
welcome to come on anytime, man. Just you have the calendar link. Just hit me up whenever, and we could just hop in whenever, man.
You got it. Jason, this was great. Looking forward to the next one. Really enjoyed talking with you.
I mean, this is a lot of fun, man. Hang
All
out
right.
for one sec.
Yeah, for sure.